Hello, I'm Josh from Coventure Tax Consulting. Today, I'm joined by crypto expert Robert Callan and tax expert Derek Andrews to discuss current thinking in relation to the taxation of cryptocurrencies and assets. Robert will explain crypto terms and give an insight into the world of crypto, and Derek will advise on the taxation issues. Because this is a changing area, it's important to keep up to date. But for now, let's jump right in. So Robert and Derek, let's start with the agenda. Derek, would you like to give an overview of what is covered in this presentation from a tax perspective?
Hi Josh, I'd be happy to. In today's presentation, we'll look at the tax environment as it applies to crypto. We'll break down how crypto is taxed, looking mainly at three areas: income tax, corporation tax, and capital gains tax, or CGT. We'll touch on mining, staking, forking, in-game rewards, and non-fungible tokens, or NFTs. We'll also briefly discuss coin offerings, or ICOs. I think this will be of interest to anyone who's in the crypto space, but domiciled individuals in particular will be keen to hear about a very recent update that targets them, and I'll touch on this at the very end.
You've already mentioned some key words. We should give some context to these. Robert, those watching this presentation will either have crypto assets or they are advising people with crypto assets. For the uninitiated, can you briefly introduce the world of cryptocurrencies and assets?
Hi Josh. So viewers may know about Bitcoin, the king of crypto, or they may be aware of other cryptocurrencies such as Ethereum and Monero. These and thousands of other coins are traded privately and also on exchanges such as Kraken, Coinbase, and Bitfinex. These coins and exchanges are all part of the crypto world, which is an emerging revolutionary force in finance and other industries. Bitcoin has led the charge in facilitating decentralized, borderless transactions, and all of this has disrupted how people think about money.
I have to admit that I only began to sit up and take Bitcoin seriously when it hit $20,000 in 2017.
That was a watershed moment. Even though cryptocurrency values have fluctuated wildly, this peak in value and the attention it garnered would lead to cryptocurrencies gaining a foothold in the world of finance.
Derek, I suppose the fact that anyone with a mobile phone can acquire and trade in crypto has led to its ubiquity. This must present significant problems for governments.
The growth in crypto did leave authorities playing catch-up. Initially, they struggled to deal with the unregulated nature of the burgeoning industry. The lag resulted in a fragmented and often confusing array of tax regulations, with no consistent global standard emerging. While some jurisdictions outright banned crypto, others like the EU are in the process of establishing comprehensive regulatory frameworks. In the meantime, in Ireland, for example, the approach has been to apply traditional tax models to crypto. This has meant that many individuals are unsure or unaware of their obligations.
Derek, let's get the obvious out of the way first. Presumably profits or gains made on the sale of cryptocurrencies are liable to tax in Ireland.
Initially, some tried to argue that crypto assets were not property for tax purposes. This view has long been consigned to the annals of history, or to use tech speak, depreciated. Similar to tax authorities in other countries like the US, the revenue commissioners consider cryptocurrencies and crypto assets to be taxable property. With crypto investments having a market cap of 2.3 trillion, it's too significant an area of economic activity to be ignored by tax authorities.
And they are taxed how?
Despite its given name, cryptocurrency is considered an asset rather than money or currency. At a fundamental level, gains from crypto trades are subject to capital gains tax at 33%.
Crypto is treated as a speculative investment then?
Yes, but revenue generally treats crypto as investments rather than trading for all individuals. While trading treatment can arise, the majority of individuals will be treated as investors.
What type of taxable events should individuals be aware of?
Most events have a tax angle, which may be news to those in the crypto space. It's not only moves in and out of fiat currency that are taxable, all events that occur in between, like selling one type of crypto coin for another, must be tracked.
And what are the rules for calculating CGT?
If a person has multiple holdings of the same type of asset, Ryanair shares for example, the profit or loss on a trade is calculated using the FIFO or first in, first out rule. This rule specifies which shares are to be treated as sold in any given transaction. It's important to know and understand this rule, especially if dealing with multiple acquisitions of the same type of asset on different.
How would the FIFO rule apply to crypto assets in practice?
Under FIFO, the first crypto asset acquired is assumed to be the first asset sold and so on. When an investor sells a Bitcoin, the FIFO method matches the trade with the oldest Bitcoin holding. For tax purposes, the cost of the oldest Bitcoin is used to calculate the gain or loss triggered by the trade. If the oldest Bitcoin was purchased at a lower price, the CGT and therefore tax owed may very well be higher than what the investor is expecting.
Are individuals obliged to declare crypto transactions?
Yes, they are. And while a person can run into difficulty for failing to file a tax return on time, we'll touch on this later, not disclosing details of acquisitions can also be a problem. Directors in particular need to be aware that failing to file all information on a return could result in that return being treated as filed late. This could trigger substantial late filing penalties.
What records must investors keep?
Revenue would expect to have access to all information, and this means keeping records of transactions on hard wallets, exchanges, etc., whether accessed via a person's mobile phone, laptop, or other device.
So what about companies?
Well, each company will have to determine whether the level of activity rises to that of trading. Now, we recommend having a strong tax opinion on file if taking a trading approach.
And if a company is to adopt trading treatment?
Well, a crypto trade is accounted for and taxed in the same way as any other commodity. Now, we've guidance on trading claims drawn from our experience and from relevant case law, which we'll share with our clients. Trading profits and losses will be declared in financial accounts, prepared in accordance with relevant accounting standards and taxed in accordance with normal tax rules.
What tax rules apply to companies then trading in crypto?
The profits and losses of a company entering into crypto transactions will be reflected in the accounts, and where they arise in a trade will be taxable under normal corporation tax rules. Where a company is engaged in a trade, profits are taxable at 12.5%. Otherwise, the profits and gains are liable to CGT at 33%.
Talking about accounts, can they be prepared in, say, Bitcoin?
Companies can prepare accounts in a currency other than the euro, but to my knowledge, crypto are not a functional currency as defined for accounting purposes. I believe that accounts can only be prepared in a fiat currency.
That raises an interesting question about whether cryptocurrencies need to be marked to market yearly for accounting purposes.
Now, that's a little outside my area of expertise. My understanding is that it depends on the accounting standards adopted.
And if not trading?
If not trading, as with the rules that apply to individuals, crypto trades will be liable to companies' CGT at an effective rate of 33%, as I mentioned earlier.
Effectively, crypto transactions by companies are also treated as speculative investments then?
That's correct. There's quite a high bar to achieving trading treatment.
Robert, can you explain what is mining?
Most people think of crypto mining simply as a way of creating new coins. Crypto mining, however, also involves validating cryptocurrency transactions on a blockchain network and adding them to a distributed ledger. Most importantly, crypto mining prevents the double spending of digital currency on a distributed network. Like physical currencies, when one member spends cryptocurrency, the digital ledger must be updated by debiting one account and crediting the other. However, the challenge of a digital currency is that digital platforms are easily manipulated. Bitcoin's distributed ledger, therefore, only allows verified miners to update transactions on the digital ledger. Many cryptocurrencies, including Bitcoin and classic Ethereum, use a consensus mechanism called proof of work. Via proof of work, the network throws a huge amount of processing power at solving problems like validating transactions between strangers on opposite sides of the planet and making sure nobody is trying to spend the same money twice. Part of the process involves miners all over the world competing to be the first to solve a cryptographic puzzle. The winner earns the right to add the latest block of verified transactions onto the blockchain and receives some crypto in return. At its peak, cryptocurrency mining was an arms race that led to increased demand for PC hardware. But the crypto mining gold rush quickly came to an end as the difficulty of mining top cryptocurrencies like Bitcoin increased. That said, mining can still be profitable.
So Derek, what is the tax treatment of cryptocurrencies received from mining?
Well, like all things crypto, Revenue has specified no distinct rules for the tax treatment of cryptocurrency mining. As traditional tax rules are applied, receiving mined cryptocurrency is unlikely to trigger an immediate tax event. However, when the asset is later sold, since there is no base cost, the full value of the sale will be subject to tax.
And lastly, is making or receiving a payment for goods or services a taxable event?
Yes, making or taking payments in a cryptocurrency, assuming for fair value, will not alter the underlying tax treatment. If the crypto has a higher value than the economic value of the transaction, this will give rise to other tax issues.
Can you explain for our viewers what is an airdrop?
A cryptocurrency airdrop is a marketing strategy that involves sending coins or tokens to wallet addresses. Small amounts of the new virtual currency are sent to the wallets of active members of the blockchain community for free, or in return for a small service, such as retweeting a post sent by the company issuing the currency.
And how are these taxed?
As yet, there are no set rules for the tax treatment of cryptocurrencies received via airdrop. When cryptocurrency is acquired in this way, it's considered the acquisition of an asset. That acquisition will need to be declared. After that, the standard tax rules apply. The future disposal will trigger income tax, corporation tax, or capital gains tax with no base cost, provided that there is no document executed in Ireland concerning something to be done here. There should be no stamp duty exposure for the recipient.
Robert, can you explain what is staking?
Mining activities, which we mentioned before, can cause bottlenecks when there's too much activity. This results in transaction times being longer and much higher fees. To overcome this problem, a new consensus mechanism called proof of stake emerged. Instead of having miners churn through math problems, a hugely energy-intensive process, transactions are validated by people who stake their tokens.
So staking serves a similar approach to mining. It's the process by which a network participant gets selected to add the latest batch of transactions to a blockchain and earns crypto as a reward?
In a nutshell, yes. When you stake crypto, you may be chosen to validate transactions. Through this activity, you may receive crypto rewards in exchange. It's similar to receiving a fee.
Okay, so Derek, how are these crypto rewards or fees taxed in Ireland?
For staking activities, individuals and companies are likely to be taxed based on the market value of the coins received.
Robert, tell me about crypto lending.
Crypto lending is a decentralized finance service that allows investors to lend out their crypto holdings to borrowers. Lenders then receive regular crypto interest, similar to interest payments earned in a traditional savings account.
Derek, what is the tax treatment of crypto lending?
Any income received from a lending activity is likely to be treated as income for individuals and companies alike. This could mean exposure to tax at approximately 50% for individuals and up to 40% for most Irish-owned companies.
Robert, what is a crypto fork and how do they work?
If you're a crypto enthusiast or investor, you've probably seen, among the many thousands of coins in digital circulation, coins with similar sounding names. For example, there's Bitcoin and Bitcoin Cash, or Ethereum Classic and Ethereum 2.0. There are soft forks and hard forks. Both are a result of changes made to a blockchain's protocol. Changes to a blockchain's underlying protocol vary in significance. Sometimes it's a minor upgrade, like a bug fix. This is called a soft fork. Other times, it can be a major system-wide overhaul, otherwise known as a hard fork. The latter is a change in a blockchain's programming that creates a new blockchain and cryptocurrency. Many projects have hard forked but kept their original names and tokens, with other groups deciding to stay with the original code and change the name.
How are these treated for tax purposes?
Like other crypto events, there are no set rules for the tax treatment of soft or hard crypto forks. Instead, one must be familiar with the rules relating to share reorganizations and apply these. A soft fork, for example, is equivalent to a reorganization of shares. The new or altered holding simply steps into the shoes of the old holding as far as the date and cost of acquisition is concerned. However, if a hard fork occurs with the result that a person has two different holdings, the rule to apply is that relating to share splits. In a share split, it's necessary to make an apportionment of the original base cost between the original holding and the new holding. This apportionment is based on the respective values of the assets on the date of the split. It can be difficult to calculate, and we've advised on a number of these, including the most recent Taproot fork, which occurred in November 2021.
Okay, a quick word about employees. If employees are being paid, I assume they are taxable in the normal way?
Yes, but this raises complications about how to fund income tax, PRSI and USC, which the employer must account for upfront. It's fair to say, I think, that this isn't happening to any great extent.
Some of our clients have mentioned gifts and in-game rewards. What can you tell us about these?
The growing popularity of NFTs and blockchain technology has greatly influenced the direction that video games are taking. There's been a huge growth in play-to-earn games, in which players can earn cryptocurrencies and tokenized assets which can be transformed into NFTs. Players unlock opportunities to amass in-game items, tokens, and cryptocurrencies, all while immersing themselves in diverse in-game activities, from fierce battles and daring exploration to intricate crafting.
Derek, dare I ask, how are these tracked, let alone taxed?
The honest answer is with great difficulty. As with traditional investing, we're very reliant on the quality of reports that can be generated from within the apps and software that our clients operate in. Because the tech business is very boom and bust, it's critical to download records and not leave them on a network or cloud. You just can't assume that a popular network or game will exist or be accessible in 3 years. Leaving aside practical difficulties, a gift or inheritance of crypto is subject to gift or inheritance tax. The value of the asset for tax purposes is based on its euro equivalent, and this will be liable to tax at 33%, subject to any relief available, such as the lifetime gift and inheritance tax threshold. However, some good news is that rewards received in a game may not be taxable, as wagers are generally exempt from tax.
Are there any other taxes like stamp duty that can be triggered?
In general, there are no transfer taxes applied to the acquisition of cryptocurrencies. However, as I mentioned earlier, if an acquisition involves a written instrument executed in Ireland or any related action carried out in Ireland, it's possible that it could trigger stamp duty.
Can you touch on the VAT treatment of crypto transactions?
The European Court of Justice has ruled that crypto is property for VAT purposes, so it's definitely possible for VAT to arise. However, most people active in crypto, whether dealing, mining or staking, are not going to fall within the scope of VAT.
Robert, would you explain what is an initial coin offering, or ICO?
Initial coin offerings, or ICOs, are a popular way to raise funds for products and services usually related to cryptocurrency. It's the cryptocurrency industry's equivalent of an initial public offering, or IPO. A company seeking to raise money to create a new blockchain app or service with a cryptocurrency can launch an ICO as a way to raise funds.
So, interested investors buy into an ICO to receive a new cryptocurrency issued by the company.
Yes, and this token may have some utility related to the product or service that the company is offering, or represent a stake in the company or project.
Derek, about the tax treatment of ICOs, let me guess, there is no specific revenue guidance on this either.
That's right. The treatment of an ICO for the recipient is similar to the treatment that applies to a fork, but with no base cost. The position of the issuer is interesting. The company could be considered to have disposed of an internally created asset, and that could be subject to corporation tax. Alternatively, the issue could be treated in the same manner as the issue of equity. For a share issuer, the issue of equity is tax neutral. If the company frequently issues crypto assets, it could be argued that this forms part of a trading activity, making the ICO proceeds taxable as income based on the company's accounts.
What about VAT and stamp duty?
The ICO should be exempt from both VAT and stamp duty. This is provided that the tokens are comparable to shares or securities. If not, well, the position could be different.
Let's talk for a moment about other crypto assets, NFTs. First of all, what are they?
Non-fungible tokens, or NFTs, are assets like a piece of art, digital content, or video that have been tokenized via a blockchain. Tokens are unique identification codes created from metadata via an encryption function. These tokens are then stored on a blockchain, while the assets themselves are stored in other places. The connection between the token and the asset is what makes them unique.
Are NFTs traded like crypto?
NFTs can be traded and exchanged for money, cryptocurrencies, or other NFTs. It depends on the market at any given time. For instance, you could draw a smiley face on a banana, take a picture of it, and tokenize it on a blockchain. Whoever has the private keys to that token owns whatever rights you have assigned to it.
Okay, so the person who creates an NFT, how is that person taxed?
Generally, tokenization of an asset is not going to trigger a tax charge, but where there's an opportunity to realize an income or gain, the revenue commissioners will look for a way to bring it within the charge to tax. An obvious example is the gift of an NFT to somebody. This will trigger gift tax based on the market value of the crypto asset.
What are the crypto reporting obligations?
Crypto assets are subject to the same reporting requirements as all other assets. Individuals, even PAYE workers, must file a tax return for each calendar year. This return must include details of profits and gains on crypto trades. The tax return must be filed 9 months after the year end, i.e. the end of October, although in practice returns are usually filed mid-November. Anyone who is active year to year will be required to make a payment on account during the year, with the final top-up or balancing amount payable with the submission of the return. Anyone involved in crypto should know that new pan-European tax transparency rules will come into effect on the 1st of January 2026. These rules will require service providers, wherever they are located, to report on crypto transactions carried out by clients residing in the EU. It will also impose disclosures on financial institutions. The bottom line is that the Irish Revenue and other taxation authorities are going to get a lot more information than they currently have.
Okay, thanks, Derek. Any final thoughts? And you did promise to mention a key development for non-domiciled individuals.
My final thought is to remind viewers that this is an evolving area of tax. Revenue will have a lot more information on individuals involved in crypto trading from 2026. I recommend advisors to check in with their clients and make them aware of the changing tax landscape. Now, I promised an important update for non-domiciled individuals. There is a significant development that affects these people. Generally, it is taken for granted that non-doms are only liable to tax in Ireland on non-Irish source income or gains, if the income or gains are emitted into the country. This is not the case for crypto. So anyone who has non-dom status might want to reach out to us directly. They are likely much more exposed than they realise.
Thank you, Derek, and special thanks also to Robert for his valuable contribution. That concludes this presentation on the taxation of crypto assets. I think you will agree this is a complicated area of tax, and my takeaway is that it's important to collate information early and get advice. So, thank you for watching, and if you would like more information about taxation issues, follow us on X at CoVentureTax or visit our website coventuretax.ie. Thank you for watching.